In today's session, we are starting off with a new topic, and in today's session, we would be learning preparation of final accounts. When we learned accounting process, we saw that there are three major steps to accounting process: recording, classifying, and then finally summarizing. I'll repeat that. According to the accounting process, you have three major steps. The three major steps are recording, classifying, and then finally summarizing transactions. So we've already been through the first two previous sessions. We've already gone through the first two steps of recording and then classifying. Now we would be discussing in detail how to go about summarizing transactions in a business. So within the scope of that, we would be learning preparation of final accounts. And as a part of this session, we would be exclusively learning preparation of final accounts of a sole trader. So we would be specifically addressing preparation of final accounts of a sole trader. So that may give you that may leave an element of doubt in your mind. Does the preparation of final account vary with the type of firm? Yes. The final account preparation would vary from type of firm. So for example, if you're a sole trader, then there is a specific way with which you will be preparing your books of accounts and your final accounts. If you're a partner, then there is a specific way with which you will be preparing your final accounts. If you are a cooperative society, there is a specific way with which you will be preparing your final accounts. If you are a limited liability company, there would be a specific way with which you would be preparing your books of accounts on your final accounts. So what we are interested right now is we are interested in the preparation of final accounts of a sole trader. Okay, so we would be discussing in that line. So let's start off with our discussion. We would be discussing preparation of final accounts. So why do you have to prepare? Why do you have to prepare final accounts? Please remember, we are preparing final accounts as a result of summarization step. Now, why do transactions need to be summarized? Transactions of a business need to be summarized because you want to know the outcome of the transactions that you have carried out. Throughout the financial year, you're carrying out a lot of transactions. You're buying goods, you're selling goods, you're paying wages, you're paying rent. There are a lot of activities that you are carrying out. But as a result of all the activities that you're carrying out, you want to evaluate and see what is the net outcome. Have you making profit? Are you making some loss? So you have to understand the primary objective of any business is to earn profit. But how do you do an evaluation? How do you a sanity check whether you're making profit or not? So for that purpose, you will have to go about with the preparation of final accounts. So basically, final accounts preparation is carried out to evaluate the outcome. You want to summarize all the transactions that your business has carried out, and you want to know what is the end result. So in that note, you may ask a big question over here. By summarizing, what are we trying to evaluate? When you summarize transactions of a business, there are two major things that you're trying to evaluate. You're trying to understand the profit position. You're trying to understand the financial position. I'll repeat, you're trying to understand the profit position. You're trying to understand the financial position. So now let's talk a little bit more about this. What is meant by profit position? Profit position of a firm refers to the comparison of expenses and incomes of a firm. Okay, when we talk about the profit position of a firm, we are doing a comparison of the expenses and the incomes of a firm. We are trying to compare, we are trying to match the expenses with the incomes. What do you mean by expenses? Expenses are those cash transactions or those transactions where there's an outflow of money. What do you mean by an income? Income are those transactions that result in inflow of money. So at some point of time, you have to compare your outflow of money with your inflow of money, and then you have to say which side is more. Okay. So if your outflow of money is more, inflow of money is less, you're running on loss. If your inflow of money is more, your outflow of money is less, you're running on profit. So based on this, you will have to take corrective measures. You will have to take some corrective steps to see why are you running on loss. Because remember, every business desires to run on profit. That is the ultimate goal. That is the dream. That is the vision with which any business is functioning. So when we excuse me. So the ultimate goal is that we want to earn profit. But how do you know, are you making profit or not? You come to know whether you're making profit or not by comparing expenses with the incomes. The next aspect that we would summarize transactions is to understand the financial position. What do you mean by financial position? Financial position, we are doing a comparison of assets with the liabilities. Okay? So the comparison of assets with liabilities is what you call as the financial position of a firm. Now, what are assets? Assets are resources of a business. Okay, assets refers to resources of a business. What are liabilities? Liabilities are obligations of a business. So assets are resources that you own, resources that you possess. Liabilities are those obligations that you have to pay off. They are commitments that you have to fulfill. So any business, what they would ultimately desire is that they want the assets to be more than the liabilities. I'll repeat that. They desire the assets to be more than the liabilities. So this comparison is what you call as the financial position. So how do you evaluate the financial position of a firm? You evaluate financial position of a firm by comparing the assets with its liabilities. Okay? You evaluate the excuse me for that. So you evaluate the financial position of a firm by comparing the assets with its liabilities. Now, you summarize the transactions with the preparation of the final accounts. So you try and understand the profit position. You try and understand the financial position by preparing the final accounts. Now, as a preparation of final accounts, there are certain mandatory statements that you have to prepare. It is mandatory for you to prepare certain statements. Now, the preparation of these statements will depend on the type of business that you are. I'll repeat that. The kind of statements, the type of statements that you end up preparing, that will depend on the type of business that you are. So in our entire session here, we will be discussing specifically within line of a sole trader or a sole proprietor. Now, who's a sole trader or who's a sole proprietor? It is a single-owned business. So the decision-making authority in a sole trader or a sole proprietor is one single person. I'll repeat that. The decision-making authority in the case of a sole trader, it is one single person. So that is what you call as a sole trader or a sole proprietor. So here we are discussing the preparation of final accounts with specific or in line of that of a sole trader. So you have to remember the type of statements that you prepare as a part of final accounts will depend on the kind of firm that you are. If you're a partnership firm, then it will be in a different type. It will be in a different way. If you are a company, it will be in a different way. If you are a cooperative society, it would be in a different way. So this would entirely depend on the type of business that you are. So the preparation of final accounts, the preparation of the statements as a part of final accounts will depend on the type of firm that you are. So in that line, let us discuss how do we go about with the preparation of final accounts. Now, our discussions would be specific to the preparation of final accounts in a sole trader. So as a result of final accounts, what are we trying to gain? What is our objective? What is our goal? We want to know what is the net outcome of all the transactions that have been carried out by the business throughout the year, throughout the financial year, starting from 1st of April until 31st of March. There are a number of transactions that your business is carrying out. What is the end result of all these transactions? So that is what we are trying to understand. And by preparing final accounts, we are trying to evaluate the profitability and the financial position of a firm. So remember, these two aspects, they are entirely different. When we talk about profitability, we are talking about a comparison in terms of incomes and expenses. When we talk about financial position, we are talking in terms of a comparison between assets and liabilities. So here we are talking about understanding the profit position, understanding the financial position. So in that line, let us talk about now when we learn the accounting process, we already saw as a part of classification, we would be preparing ledgers. So ledgers are prepared in the books of accounts, which are called as so they're prepared in the books of accounts, which are called as ledgers. As a part of classification process, you would pick up the transactions from journals. Journals are primary books of accounts, They're called as primary books of accounts because this is the first place where you would end up recording your transactions. As and when the transactions are taking place, chronologically, you end up recording them, putting them into your books of accounts, which is your journals. From your journals, depending on the nature, depending on the type of business that you have, you would pick them up, you would classify them, and you would put them into ledgers. Okay, you're putting them into ledgers. So this you're carrying out as a part of classification process. Now, you already learned that ledgers are secondary books of accounts. We already saw that ledgers are secondary books of accounts. We also had some experience preparing ledgers for some accounts as well. So we saw that we would look out for, we would scan through, we would screen through the journal, we would try and identify similar transactions, pick them up, group them together, bring them into ledger, and then write them over there. So that is what happens as a part of classification preparation of ledgers. Now, once your ledgers are prepared, at the end of the financial year, you would prepare what is called as the trial balance. Okay, at the end of the financial year, you would prepare what is called as the trial balance. Now, at this point of time, it is very difficult to say, is trial balance a part of your classification process, or is trial balance a part of your summarization? Because the trial balance acts as an important bridge between these two steps, the step of classification and the step of summarizing. So trial balance acts as a link between these two steps. It is very vital. Why do I say this? Trial balance cannot be prepared without the help of ledgers. At the same time, you can start the preparation of final accounts only with trial balance. So that's the reason why this is very important. That's the reason why this is very vital. So it's very difficult to say, is trial balance a part and parcel of classification, or is it a part and parcel of summarization process? So ledgers gets prepared with the help of journals, and then you use your ledgers, and then you will be preparing your trial balance. Now, what do you mean by trial balance? Trial balance is a summary of all the ledgers in a business. I'll repeat that. Trial balance is the summary of all the ledgers that you have in a business. So let's say if you have 100 ledger accounts, your trial balance reflects the balances of all the 100 ledger accounts. If you have, let's say, 150 ledger accounts, you will get all the balances of all these 150 ledger accounts in one single place. So that's the reason why trial balance is the summary of all the ledger accounts in a business. At the same time, you can start off with the preparation of final accounts only with the help of trial balance. Without preparation of trial balance, you cannot prepare final accounts. Now, once you decide to prepare final accounts, please remember the first thing that you will have to do is you will have to prepare the trial balance. So remember, the financial year in India, it starts from 1st of April until 31st of March. So once you have crossed 31st of March, your accountant has closed all the books of accounts. He has put in all the transactions for the previous financial year. Then what the first thing that he would do is he would prepare the trial balance. Okay, he will be preparing the trial balance. So only if you have your trial balance in place, you can start off with the preparation of your trading account. Only if you have your trial balance in place, you can go about with the preparation of your trading account. Now, the first statement that gets prepared as a part of your final account is your trading account. I'll repeat that. The very first statement that gets prepared as a part of your final accounts is your trading account. Now, trading account is prepared to evaluate the gross profit. Trading account is prepared to understand the gross profit of the firm. So the first statement that gets prepared is your trading account. Once trading account gets prepared, the next statement that you will be preparing is your profit and loss account. Trading account is prepared, the next statement is your profit and loss account. After you have prepared your profit and loss account, the next statement that you will be preparing is your balance sheet. Okay, the next statement that gets prepared is your balance sheet. So as a part of final accounts of a sole trader, as a part of final accounts of a sole proprietor, there are three statements that you will be preparing: trading account, profit and loss account, balance sheet. Okay. So as a part of final accounts of a sole trader, there are three statements that you will be preparing: trading account, profit and loss account, and then balance sheet. So please remember, depending on the type and nature of firm that you are, these statements would vary. So for example, if you are a partnership firm, then you will have to prepare 5 statements. trading account, profit and loss account, profit and loss appropriation account, partners account, and then balance sheet. So the type of statements that you end up preparing depends purely on the type of firm that you are. So here, since our interest is on the sole trader, as a part of final accounts of a sole trader, there are 3 statements that you'll be preparing: trading account, profit and loss account, and then balance sheet. Now, we've already seen that trial balance is a summary of all the ledgers in a business. Trading account is prepared in order to understand the gross profit of a firm. I'll repeat that. Trading account is prepared to understand the gross profit of the firm. Profit and loss account is prepared to understand the net profit of the firm. Okay? Profit and loss account is prepared to understand the net profit of the firm. So I'll repeat that. Trading account is for gross profit. Profit and loss account is for net profit. Are they the same or are they different? If they're different, how are they different? Now let's talk about that. What do you mean by gross profit? Gross profit refers to the profit that is earned by a business from its core activity. Okay? So you are a sole proprietor, and because you're a sole proprietor, as a part of your business, you may be having some core activity. So that profit that you generate is what you call as the gross profit. Okay, that profit that you end up generating is called as the gross profit. Then you have net profit. What do you mean by net profit? Net profit refers to the total profit. Okay, net profit talks about the total profit of the firm. Now, I will try and explain what you mean by profit from a core business and what is profit from net profit. What is the net profit? Imagine I am an entrepreneur, I'm a sole proprietor, and I have a bakery business of my own. Okay? So I'm an entrepreneur, I have a bakery business of my own. So as a part of my bakery business, I would be selling bakery items. I would be selling breads, I would be selling buns, I would be selling pastries, I would be selling cakes, I would be selling some snacks. So as a part of my bakery business, there would be certain activities that I would be carrying out. Okay? But I'm pretty good in accounts as well, and I realized that I have a lot of free times in the evening. I do not have much business happening, so I decided to run tuitions in the evening. I decided to take accounts tuitions in the evening. So you have to remember, I'm generating profit from 2 ways. I'm generating money from 2 ways. I'm generating money from my core business activity, which is the activity of running a bakery, and I'm also generating profit I'm also generating revenue by conducting tuitions. So if I try and evaluate what is the profit that I'm earning from my bakery business, that is my gross profit. Okay? So the profit that I'm earning from my bakery business, that is my gross profit. At the same time, I would also be making revenue from tuitions. So my bakery profit plus my tuition profit, that is the measure of my net profit. So gross profit, net profit. Gross profit, the profit I'm earning from my bakery activity. Net profit, my total profit. So total profit includes my bakery revenue plus my tuition revenue. So that is my net profit. So gross profit talks about the profit that a business is earning from its core activity. Net profit talks about the profit that a business is making from all its activity. So it could be your core activity and it could be some other activities as well. Now together, trading account, profit and loss account, they are called as the income statements of a firm. The trading account, profit and loss account, together it is called as the income statement of a firm. Now, why is it called as the income statement of a firm? From these 2 accounts, you will come to know the firm's incomes. You're coming to know what are the firm's revenues. Okay, so from trading account, profit and loss account together, you will come to know the income of the firm. Okay, that's the reason why it is called as the income statement. Okay, that's the reason why it is called as the income statement. So income statement, it is called as income statement because you're coming to know the income of the firm. You're able to understand the profit that the business is making. So trading account, profit and loss account together, this will help you to understand the profit position of the firm. And then why are we trying to understand the profit position of the firm? You're trying to understand the profit position of the firm because we're trying to understand the income that is made by the firm. So collectively, trading account, profit and loss account together, it is called as the income statement also of a firm. It is called as income statement because we will come to know the profit of the firm. That's the reason why it is called as the income statement of the firm. Then finally, we prepare the balance sheet. So why do we prepare the balance sheet? We prepare balance sheet to understand the financial position of the firm. Okay, we prepare balance sheet in order to understand the financial position of the firm. So financial position of a firm is determined in terms of assets and liabilities. I'll repeat that. Financial position of a firm is estimated in terms of assets and liabilities of the firm. So in a nutshell, we've got an overview about the preparation of final accounts in a sole trader. We saw that final accounts in a sole trader, you start off with ledgers, then you prepare trial balance, then you prepare trading account, profit and loss account, and then finally balance sheet. Trading account, profit and loss together, it's called as the income statement. It is called as income statement because you come to know the profit position. Then you prepare the balance sheet. Balance sheet is prepared because you want to know the financial position. Financial position is estimated in terms of assets and liabilities. So with that note, we have got an overview about the preparation of final accounts in a sole trader.